All right, looks like we're live. So, welcome to the Trading Homework broadcast. If you're watching this in replay mode, you can watch it slightly faster speed if you want. I don't have like music playing or anything, so it might help you get through the content faster. Tonight, I've got a hot tea that I brewed, which I'll be enjoying while we go through the trading homework. And it's in this Las Vegas mug. So I like to think of this as an homage to Ed Seykota meets Ed Thorpe. All right, so let's get to it. I've got a lot of trading homework broadcasts that I put out over the weekend. And one of the ideas that we ended on last night, a lot of these ideas didn't really get finished until the trading day. So I wanted to recap how, based on what happened through the trading day, what happened with those ideas and how those got translated into trades. So the first one I wanted to start with is HYG. So let's back up and take a look at... a lot of people were noticing LQD. Let me change this bar size, make it easier for everyone to see what's going on. So that's really too zoomed in. So there's a big down bar here. It looks like kind of a major breakdown. And we had been observing TLT and noticed that had been in a long downtrend. And this is really significant. A lot of people on Twitter are starting to talk about how high the long rates are getting. And short rates aren't very likely to go up. In fact, we could see some issues with negative interest rates popping up in certain places. So if you want to know more about that, I've tweeted about it. There's a notes from Zoltan Pozar. Sorry if I mispronounced that. And that's on my Twitter. I retweeted that and put my little take on it. Long story short, the Federal Reserve will pay institutions an interest rate to essentially wink their money out of existence overnight, and they're paying them an interest to do that. And that interest rate is higher than what they can normally get in the marketplace for the same kind of overnight deal. And so that incentivizes these institutions to park that money. It's usually like excess reserves, to park it with the Fed, and that kind of keeps it out of the monetary system from sloshing around too much. However, Zoltan pointed out that there's a cap. So this is a reverse repurchase, overnight reverse repurchase agreement facility. And Zoltan pointed out that there's a cap. I think it's like $30 billion per institution on what they can park in this facility. And he said that money that can't fit in there is going to have to seek other places to, essentially to warehouse. He used the word warehouse. And that those rates might turn out to be negative interest rates because they're going to be less than probably the RRP, reverse repurchase facility interest rates. Because, I mean, if they were a greater interest rate than the RRP rate, then everyone would just put their money there instead of going to the RRP. So that there is all this money at the RRP means that it's really like the most attractive rate they can get for that kind of like an overnight money deal. So anyway, that's really a high level view of what's going on. If you really want to know a lot more and do a deep dive on this topic, you can go read the Federal Reserve publications. They publish this kind of stuff on their website. And so you can read all the details you want about that. I linked to one of those papers, or it's really like a summary of a whole bunch of white papers that they published. So back to what this means for the bond market. We've got that stimulus coming up, And I don't know the exact date that it's going to happen, but I'm really looking for a way to get some money on this play besides just long commodities. I'm looking for a rates play. And so what jumped out to Chris and I last night, I was on with Chris, the Fibonacci trader. He's on Twitter, it's at Sell the Fucking Rip Trader, or STFR Trader on Twitter. So he had some really great insights to add to yesterday's trading homework. He's not going to be able to join us tonight. But anyway, what he had pointed out was that there was interesting things going on with IYR, and so we kind of jumped over to REM, and we looked at these interest rate sensitive things. So let me zoom out on the chart here. So and let's jump to where we got to. Was it HYG? I could bring it up on the Federal Reserve website that shows. In fact, here, let me do that now, and I'll show you guys how to get to the data series that I like to use for measuring high yield credit spreads on the Fred website. So I got a tab with Fred open. I'll jump over here. It's really easy to find this. It's such a popular data series. I'm really glad. So on their website, popular series, and it's this one, ICE, Bank of America, U.S. High Yield Index Option Adjusted Spread. And as you can see here, like it's very, very low right now, 3.47. And what this is measuring, I'll summarize, but if you want, if you're watching this on replay, you can freeze frame it here. Or you can go to this site yourself and read about it. But essentially, it's the rate that high yield bonds are paying on average above more investment grade corporate bonds. And so I don't think it's a spread above. Yeah, so it says here, ICE, Bank of America High Yield Master 2 OAS uses an index of bonds that are below investment grade, those rated BB or below. And again, this is a spread. So what is it spread against? I don't think it's treasuries. Yeah, investment grade. Yeah, it looks like. Anyway, you can find out those details if it really matters to you. The point is, it's a very low interest rate right now. So what this means is that people who bought high yield bonds back, like, in October, or I'm sorry, in I don't know why I said October, Freudian slip, I guess, back in March of 2020 during the coronavirus crash, let's call it that, or the lockdown crash, maybe that's a better word for it. They were getting a very large interest rate in excess of, or let's call it a premium, to go into high yield bonds instead of investment grade bonds. And so people who had investment grade bonds could sell those investment grade bonds and rotate into high yield bonds. And then the way that the credit cycle works is that they're typically going to hold until that spread collapses back down. So when the spread is wide, they rotate from the investment grade stuff to the high yield stuff. And then and they may even be borrowing to put on an even bigger position. And when the spread collapses back down, what they essentially do is rotate from the high yield stuff back into the investment grade stuff. And there they wait until the next opportunity where the spread gets wide again. And so what they may be rotating into is, it may not be investment grade corporate bonds, it may be treasuries, or who knows. I mean, people are doing all of these things. And it's the aggregate activity that they're doing that sort of creates this graph. So this is a really important one to be aware of. So the point is, it can stay down here for a really long time. But when it's down here, it's vulnerable to shocks. And so I view the stimulus episode coming up as it may perhaps a catalyst for interest rate shocks. When that happens is there will be those who have not already moved from high yield bonds or junk bonds into quality investment grade bonds. What happens is the music stops and they don't have a chair and those bonds sell off. So when you see this interest rate skyrocketing here, what that looks like is if you're an owner of the asset, if you own the bond, then the price of your bond is going down. So let's take a look at what that looked like on HYG. You can see right here, this is what happened to the holders of junk bonds or high yield bonds, is their assets fell substantially in value. And so this is a basket. Some bonds lost a lot more than this. So let's figure out from peak to valley what that percentage is. And keep in mind, this happened over a period of about a month to 2 months. We're going to talk a little bit more about these details as we get into the trade I put on today. Let's figure out this percentage. So I have a calculator up here, and this is not, I'm not trying to suggest that we're going to see the exact same percentage move, but it is helpful to know how big these shocks tend to get. And the shock in 2020, it had a big resemblance to the shock in 2008, 2009. I mean, it looks almost like the same thing. If you look, let me just expand the timeline out here, and you can see that it almost got as bad as the 2008, 2009 financial crisis. And just because it was so short-lived, I think that it didn't get worse. But that is a really interesting detail, that these things seem to be happening at greater velocity when they do happen. And so that's why I feel like if it's inexpensive to have a position on that can exploit this, then I probably should be at least ready, or if not, with 1 foot in the door. All right, so let's put this back, and I'm going to hop over to HYG, and I'm going to figure out from peak to trough, just these numbers as they appear on the labels, and figure out what that is. So I'm going to do 64.48 divided by 84.13 minus 1. So a 23% drop in HYG. And I mean, that is like a ridiculous move. It's huge. However, the kind of catalysts we're looking at could trigger a similar move, but based on monetary policy and fiscal policy, not so much based on a virus. I know that people might be concerned about, they're seeing Ebola headlines. I'm not worried about Ebola right now, and here's the reason. Even though we're seeing headlines about it, the thing is, everyone's so paranoid about getting sick right now that it's any kind of virus is unlikely to spread far because of all the precautions people are taking right now. So I don't think Ebola is going to wreck the oil market like what it started to do in, I think it was 2015, 2014. They're around that time frame. And so, by the way, you could see that scare right here. If I zoom in on it, you can see it a little bit clearer. But yeah, there was a pretty good shock starting in 2014 into 2015. And that part of what was a driver for that was Ebola. We heard it was running like crazy, and then it just disappeared from the news completely, seemingly on the brink of a pandemic outbreak that was terrifying at the time for a lot of people. Okay, so now that we know kind of the magnitude of what's possible, we have at least established an optimistic range for how good a trade could get shorting HYG. So this is a bet on the yield spread widening on high yield bonds. So we were playing around. One thing we looked at was using a back spread to a back spread. It was a credit spread on puts, using selling an in the money put, buying an out of the money put. That was pretty close, and then using a ratio to buy more puts. So essentially a ratio back spread on HYG. I realized after the broadcast ended why that's not a good idea, because between now and let's say a month out, I'm looking a month out, and we'll talk about that more in a minute when we're looking at the calendar, but between now and a month out, HYG is probably going to issue another dividend. It'll have an ex-dividend date. And so if you're short and in the money put, then you might get exercised on. Maybe it's a possibility. So and it's not that that's necessarily a problem, but just that it kind of wrecks the position that we're trying to hold. And so I didn't go with a back spread on HYG puts. I'll show you what I did do, though, is I started looking at okay, so I have HYG up, and I looked at I just started scrolling through here and looking at like the 88 and the 87 strikes, because at the money was 87 put. And I mean, these are so cheap, but the odds of any kind of move happening in 3 days, like that's not really what I'm trying to do. So I went further out. I went to, I think it was the March 19th. So this has 31 days left. So it has about a month. A lot of damage can happen to this thing in a month, as we've seen, although it's panic conditions, but we might see some kind of a currency-based panic that could tip this thing over. And so what I ended up doing is I looked at all of these strikes. What I ended up doing was going with like a rainbow kind of a combo. So I'm in the strategy builder, and this is just in paper trading mode. This is IB in paper trading mode. It's not my real account or anything. I'm just trying to use this as a tool to look at their options combos. I built a combo that looks like this, and I'll explain why. So if you look at this combo, you guys can see that, right? Okay, so if you look at this, it really starts ramping. It ramps a lot more than if you look at any one of these by themselves. And so what I really like about this is the break even on this is just under 86. Whereas if you get just the more aggressive puts, the break even is a lot lower. However, by doing it like this, it's got some acceleration. If a shock does happen, we get a fat tail event, it's really got some acceleration. And so for a minimum investment of $112, you can see that the ask on this is $1.06. And the bid-ask spread isn't too wide for having 4 different options in it, so this is pretty liquid. But I mean, take a look at this. The minimum investment is $100, and it can have at a minus 10% drop, which would be half of what we saw during the what did I call it? The lockdown crash. This is a 20x payoff, and out here at minus 20%, you can see it's like it's just about 55 times payoff. So if things really do spiral out of control, this is the kind of payoff that's very similar to what Bill Ackman had constructed and put on just ahead of the lockdown crash. He bought some similar protection that he ended up holding it all the way until expiration and cashed it in for, I think it was 100x payoff, which is slightly higher than this, but this is pretty darn good. So for a similar move, this one gets 55 times. It's not 100 times, but that's okay. I'm not sure what exactly puts or credit default swaps or whatever he had put together, but I think this is probably good enough for most people. And the other nice thing about this is so liquid. I'm not saying that I have any plans to liquidate this early. What I may do is there are weekly options. I may just, as this kind of like time decays against me, if it doesn't start working right away, which I don't expect it to. If it doesn't start working right away, then my plan is to essentially just buy a little bit more and a little bit more each week so that I maintain a similar exposure. And it doesn't hardly cost me anything, and I can protect a lot of portfolio with it. You know, I mean, this is super liquid. It's cheap to put these on. There are variations you can do. They give it a little bit higher payoff. So things you can do is let's get rid of the 87 here, and if you want to make this a little more aggressive, and let's replace an 87 with more of these 81s, so that if things spiral out of control, then we've got even more tail risk coverage. So it looks like we can replace 187 with an additional 4 at the 81 strike. So I'm going to go ahead and do that. Oops. Let me remove that. And then I'm going to set this to 5. And you'll see it should have about the same price. So yeah, it costs about $100. The commission is going to be a little bit higher because you're pushing more contracts through, and because you're a little bit more out of the money, it's got maybe a slightly wider bid-ask spread. But as you can see now, I think this pays more. Yeah, that's a 80 almost 83 times payoff for that for a 20% drop. And again, I'm just trying to benchmark against what Bill Ackman had put together. So likewise, we could do a similar thing here. We can get rid of one of the 85s and buy 2 of the 83s. And I think we might be there looking at like 100 times like what Bill had. So I mean, this is more just a curiosity than anything else. The problem with putting it on like this is you'll see that the break even is now 82.5 instead of 86. So at 86, what's so nice about that? That's just 1.8% lower. Does this get us there? No, only an 80 times payoff. So that didn't even really get us all the way there. I mean, maybe if we just did it all with, if we do a bunch of the 81s, let's try that. So I don't like going so far out of the money. The one I showed you first with, 4 different options, one of each, the 87, 85, 83, and 81. That's what I put on today. I just bought, just started slowly nibbling on it. It's fun to play in this thing. That's why I have this paper trader open for us to look at. So let's see if this gets us there. Did I lose connection? Looks like I'm still broadcasting, but Interactive Brokers is not. It's not updating here. Don't know why. Maybe it doesn't have anything to say about that. Oh, you know what? I know what it is because it wasn't a combo. I only had a single option in there, and I had 7 of them. And what it does is it will reduce it to just one. And so it was funny. It was confused. Let's compare this to just buying the 87, this combo here. So and really what I want to pay attention to is this 10% drop, because I think if the stimulus comes out and the market goes funny and interest rates go funny, this might be a feasible target. So 20x payoff. Let's compare that to if we just get the 87 here. And the way to up the quantity on it is, yeah, it's not going to let me up the quantity. So the minimum investment is $81. So this one makes up the bulk of the cost. And looks like, I mean, it's still got a decent payoff. It's just it pays less out here on the outliers. So, all right. Anyway, so there's that. We walked through a HYG. I'm calling it a rainbow combo. So what's next? Let's talk about GameStop next, because I did put on a GameStop trade. We talked about GameStop trades. Chris had one that he liked yesterday. I don't know if he put it on or not. I'll tell you real quick what it was that he was looking at. He had figured out some Fibonacci levels. He likes to use Fibonacci. And so he had figured out some Fibonacci levels and identified a resistance around, I think it was around almost 80. And so I think what he was looking at doing was selling a put spread and then buying some shares and doing a covered call. So it's a bullish position. And I think he was looking at selling, I think, a 90 strike on GameStop. Let's go to GameStop. I guess I closed the GameStop tab. Well, anyway, not a problem. Here's one. So I think the put spread that we were looking at was it might have been a 45-40. I don't know. But and then I think he was looking at, buying some shares and doing a covered call, selling, I think, a 90. So he'd be collecting a decent amount of premium. And if he did get those shares called away, he'd collect the premium, or he'd be likely to collect the premium on the put spread. Maybe if his shares got early exercised and called away, then I mean, it could still crash back down, and he could lose money on the put spread. But it's very likely that both of those would work out if the shares go up. So it was kind of a bullish trade, and we were looking at a time frame of 10 days out. Well, I got to looking at it some more today. And what I figured out that I liked was I went all the way out to April 1st, because that's where the weeklies stop. So if you notice, like, it goes from February 19th, week by week by week. You get all the way to April 1st, and then there's 2 weeks till April 16th. And so the furthest out weekly is April 1st. And so I brought this one up. And this was pretty early in the morning. GameStop, it started off pretty strong, and you can see that it closed down at under $50. But the time where I put the trade on, it was like 53. And so what I did is I bought a 55. Hang on. Let me go into the strategy builder. I bought a 55, which was pretty close to at the money. The reason is there's not a whole lot of time decay if your option is at the money and it's a little further out. And the other thing I want to show you is notice the 55 is $11.50 when it has 44 days out. We're going to look at the March 26th one with 38 days out. I want to show you how much time decay we can expect if the price continues to stay roughly where it's at, but without maybe losing too much time premium. So we're going to look at the 55 strike on March 26th. And you'll see that it's not that much cheaper. It's the ask on it is 1075. I wish I had midpoint as a column here. I could probably add it, but so 1075 to an ask of 1150. So the point is this: if you go, this is a tactic I've used before, is putting on stuff that for trades like this, where I have a pretty intermediate to short-term time horizon, and that means something different for everyone. But for me, like 1 month out, I would say is like an intermediate time frame. I don't know how long GameStop is going to sit in this range, but the more of these tight closes there are, the more bullish I get. So, if this just sits here above this sort of shelf with a support of 43, if it sits there above there, I'm not going to be experiencing much time decay. If I let it age a week, and then when a new weekly option appears at April 7th, then I roll my April 1st out to April 7th, I can expect to pay about $1 to do that probably. And of course, if the implied volatility drops, which it might, I mean, it's big, it's 173 right now and falling. If it does drop, I may lose a little bit on that as well. So the other part of this combo is I don't remember exactly what I got, but I think what I had was a 46 put expiring in just a few days. And this did not really provide much protection, but the puts are so expensive. If you look at it, it does look like the Nike swoosh. And so, I mean, this put is really only just good for another day or two. If you hold it till expiration, now you're talking about all the way down here. A ton of time decay. But for one more day, I'm good. So the problem is I have to figure out what I'm going to do after that, as far as having protection on it. It's a good thing I got the protection, because what happened is GameStop fell 7 or 8% on me. And because I had the swoosh position, I didn't really lose that much. I don't know that this call really advanced much, and I don't think I even did a roll on the call. But what I did, I don't think I did a roll on the put. What I did is I rolled this 55 strike down to a 50, and the loss was 50 and a half. And the loss wasn't that bad, but you notice it still looks like a swoosh. And what I've done is I've kept my call at the money to minimize that time decay. So looking back out here on April 1st, there you go. You can see that I rolled from a 55, so it didn't cost me that much to roll down in strikes at the same calendar. I will point out that there is not lower strikes right now on this April one. And so what I did is I looked ahead, and here's the nice thing, is there are lower strikes on the 1 week further in. And so what I can do, if it drops again, is instead of just eating the loss and posting a debit in order to roll up, I can roll up, and I'm saying up. Why am I saying up? It's down. I'm rolling down in strikes from 55 to 50 and a half. I had to post a debit to do that. Normally, the put would rise in price, and I would roll that too on a swoosh, but it didn't fall enough for that put to really go up because it's so short dated. Which is why I normally buy those puts with more than 2 weeks to go on them, is because that time value sort of broadens out the area where the price area where you're protected. So what I can do, what I looked ahead to, that I can do is I can roll in. So if you look here, I have about $13 I can work with here, or 12, right? And so if I have to roll down in price on strike prices again, what I can do is I can, this one will be cheaper too, the 45, and I could probably roll down and in on the calendar. and that won't probably be anywhere as big of a debit. And I don't care if it's, if it has 1 week less, 38 days, it's plenty of time. So I built the trade from the beginning so that I can do these kinds of things. What I have to worry about next, though, is that put. And so probably either tomorrow or the next day at the open, what I'll do is I'll look at it tomorrow. So here we are, and it's tomorrow. We're at the end of the day. I'm going to look at how things are and decide if I want to carry it into the next open. So about half of that drop right there will happen in the overnight if the price doesn't move. So if you notice, like, this is kind of the lull right here. But so something else I looked at too after I put this on is, let me just go back to the beginning on this. Let's look at these puts. So one thing I was looking at is, instead of going with a 46, how much did that 46 cost? It costs $1.58. So that's on the cheap side, right? Like protection that has 2 weeks or more to go. I'm generally looking to pay about 25 to 30% of the price of the call I'm trying to protect. And so if I have to pony up a little bit more debit, I have some choices. So one thing I can do is I can get 2 of these 42s, and I'll show you what that looks like. So that would cost about a third of the price of the call I'm protecting. And so let's take a look at this. And this has more duration, and look at how nicely that is protected. And it does have some time decay because there are 2 puts that are further out of the money that are time decaying. So anyway, that was one thing I looked at, is kind of turning it into a ratio. Sometimes you have to do things like that. Let's compare that to if we just get like the 46 put with 10 days to go. And that still looks pretty good, and this will time decay more gracefully. So this is probably the way I'm going to go. But it's nice to have that move at your fingertips, using a ratio like that, just in case you need it. And sometimes you do. That move is what allowed me to get into CCIV on Friday, because it has only monthly options. And so I had to get really creative about how I could protect the call I wanted to buy. And that worked out great. I don't know if you guys have seen CCIV today. And the move might be over, but this is one of the strongest stock charts I've ever seen. I mean, this looks like Taser or something, early on its run, just stair-stepping higher, really nice. I mean, I don't know what's going to be a driver for this, but I mean, maybe think about this as this SPAC is essentially in an air pocket all the way up to what would be an IPO price of, who knows what valuation they would use for the public, right? I mean, we've heard valuation talks about $12 billion valuation for Lucent, I think. But and so there's a video that was put out over the weekend by what's the guy's name? YouTuber Meet Kevin. And if you can make it through all the ads, he's just got it packed full of ads. Unfortunately, hey Kevin, if you hear this, man, take it easy on your monetization, dude. Where he talked about different valuations of Lucent and where that would put the CCIV price. And I think 12 billion was something like $20 or $30 for CCIV. But nevertheless, the news comes out of the 12 billion rumor. Maybe it's more than a rumor. It's and this thing's just running anyways. So what's going on here? I don't know, but it may be that there's more than one acquisition or merger that happens. Maybe they are shopping around and going to fold multiple companies into one and not just Lucent. And so, the more money they can get in here, the greater the synergy they can build or something. I don't know. I mean, this thing is certainly overbought, but when a stock chart looks like this, being overbought doesn't really mean a whole lot to me. Here's a guideline you can use when a stock is really running like this. People might wonder like why I have these particular lines on here. Here's one reason. When a stock is really moving like this, if it gets too far up above its 5-day moving average, you can let some go and buy it back at the 5-day moving average because it's almost always going to come back down to the 5-day moving average. Even so, this was something I used on VXX in March of 2020 when the market was crashing. Is when it stayed above the 5-day EMA like the whole time, but when it got too far up above it, I let some go, and when it fell back down, I started rebuilding that position. Did a similar thing with today with Riot. So I had talked yesterday about what I talked yesterday about doing was rotating from Riot into Marathon Patent Group, which is another Bitcoin mining stock. I didn't end up doing that rotation. I just ended up getting rid of half of the Riot, with the thinking that I can put it back on in Marathon later or in Riot. But I mean, Riot kept outperforming this morning, and I took a look, and I'm like, well, it's probably going to keep outperforming. So I just I held on until about halfway through the day, or maybe a little longer, and then I thought, I think where I let half my position go was right around where it closed, and so I didn't get the high of the day, which would have been great, but it's just it's had a huge run, and it could keep right on going, but it's fine to wait for a couple of down days. When these calls get overheated, they can, because it's not shares, it's calls, so there's a volatility premium, and when it's just like up like this, a lot of times when a single down day happens, it can cause the volatility premium in the calls to collapse, and they get a lot cheaper. There are other things that I could have done. So because I let half my calls go, I have protection. I have put protection that I've been rolling at the original strikes. Or I think I rolled up one strike, and so those puts are so cheap that they're essentially worthless. And so I actually kept the puts, and so now I have twice the put protection on the calls that I have, and I may even add just a little bit more and use that to, if there is a shakeout, use the essentially like sell the puts to help finance buying the calls if there's a shakeout. A shakeout may not happen. This is Bitcoin. It can go up for like a month straight, but when it goes down hard. The moves on this are huge. This is one of the bigger runs that this thing has seen. Wouldn't surprise me to see it go straight up all week, which is why I kept half the position, because that's really what I wanted to do. If I had more things working better sooner in my holdings, then maybe I would have. I wouldn't have felt compelled to like raise a little bit of cash from this position that was working so well. Let's just take a look at that real quick, and I'll show you. I'll show you the combo. So what I have is the June 18 call. I've been holding this since the price was about 18. So I've mentioned this before on here, but where I first got into this was on this little dip. And I got in when the price was like 22, and I bought put protection. What I had bought was the 22 call, and then I bought a 22 put with 3 weeks to go. And when the price dropped to 18 or just a little above 18, then the put became valuable enough for me to essentially roll that entire position down in strikes for free. And so I've been riding it up from 18 or 18 and a half ever since. If you look at that drop right there, that exact low, And if it kept on dropping, that protection I had just would have kept on allowing me to roll lower and lower strike in June. And so let me show you the put protection that I have now, which doesn't really protect the gains. What I have is the 43. And if you look, it looks like just a diagonal line here. It's because it's up so much. If we zoom out, you can see like this is where it came from. And so that put doesn't protect me hardly at all until I get all the way back down where I came from. So essentially give back all the gains. But it doesn't really cost me anything to keep it because it's so cheap. And so because I sold half the calls, what it does is it morphs the position into something like this. So take a look at that. It's the protection kicks in a lot sooner. It kicks in closer to $30. It starts slowing the drop instead of like all the way back down to 20. And the other thing that I can do is I can double these puts very easily. Like as the price goes higher, I have so much gains that I can keep adding to this put position. And what it does is it pulls it higher and higher where I'm covered. So if there is a shakeout, like say it gets really nasty, well, I've got my gains protected by a lot, and it didn't really cost me anything to do it. And it's not that I'm trying to protect it, but really what I'm trying to do is use the increased value from these puts to finance the buying back that half the position I sold, only like really cheaply. So I don't know how many of these puts I'll buy, but and what I may do too is when I roll it. So if we get to the end of the week and I roll it, I may roll it from a 17 up to an 18 out here. You can see it's a lot more expensive right now. The bid spread is wide, but I mean if it gets reasonably priced, then I may do that, or maybe not. I don't know. These are all just possibilities. So we can move on from Riot. We've talked about CCIB, talked about GameStop, HYG. Oh, the other thing I want to point out about that HYG trade is that kind of protection can protect against a market drop in your whole portfolio. And if you're putting on these swoosh kind of trades, you're going to have protection for a lot of the newer positions that you're putting on. But the ones that have big gains, you have to protect those differently because, out here you're just riding up and down this diagonal line, and it's great when it's moving higher. It's just like bigger and bigger profits. But if the market tanks on you, then it can get ugly real quick. And so that's another reason why I like to buy portfolio level protection. All right, the other thing I wanted to cover before we finish up for tonight, and I know we're just kind of doing a recap. So I could talk about, I'll talk about two things before we close out. I'm going to talk about CCJ and AG, but the other thing I want to talk about is Tesla. So I did put on a Tesla position today, and I think the opportunity to put on a similar position exists tomorrow. I should have got to it yesterday, but I put out like 4 or 5 hours of research on YouTube this weekend, and there was just so much to talk about that I didn't really get to Tesla. Why don't we talk about Tesla first, and then we'll jump to Cameco and First Majestic. All right, Tesla. So first of all, I'll mention I have a similar position in NVIDIA that expires this week that I put on at the beginning of last week. So the kind of trades that we're going to be talking about now are ratio back spreads with 2 weeks to go, and I like to put them on at the beginning of the week. So as the week goes on, later in the week, I'm looking at the 1-inch punch kinds of trades, the day before expiration, super cheap options. But early in the week, I'm doing something different generally. So let me show you with NVIDIA the position that I have and a little bit about why. And then we'll flip over to Tesla and look at why Tesla is a better place to go this week, because these kind of trades, you typically want to start them with about 2 weeks to go. The problem with NVIDIA is NVIDIA has earnings next week. And so the kind of options strategies that you would want to use on an earnings week are different. You would not want to put on a trade that is that gets hurt by drops in implied volatility. This ratio back spread, it makes money when volatility goes up, and it makes money when the price goes up. So you can see that NVIDIA is breaking out. I've had this for actually for 3 weeks. I ended up rolling it, I think. The price fell here, and what that did is it let me roll down to a lower strike, and at the same time push it out a week. So I've had this similar position for, I think this is the third week now. So because it's run up so much, the whole thing is fully in the money right now, and so I'm at that point where if it goes up a little bit, it'll make a lot of money. So let me show you what the position is. And this is a ratio back spread. If you want to know more about ratio back spreads, there's a great book by Lawrence Macmillan called Options as a Strategic Investment. He's got some chapters in there about ratio back spreads. So let's take a look at NVIDIA. I did not even put that on the list. But it's a nice intro to what I'm looking at with Tesla early this week. And we did have one less trading day. Tomorrow's already Wednesday, so just keep that in mind. But all right. So there's not a whole lot of time left on this one, but I'll show you the exact trade that I have. So it has 3 days till expiration. It is made from calls. I sold a. Hang on. Gotta go to Strategy Builder. Sold a 550, bought a 565. Now let's look at where we're at right now with that. This is just the start of it. You notice the margin impact is 1,500. It doesn't have a credit, or it does have a credit right now, but don't worry about that. And the other thing I have is I have 2 of these 600s. And so when I put this trade on, it was like right here, okay? It was in this area, this zone. And so let's zoom in on this. So when I put the trade on, it was in this zone right here. And so what that meant is in front of me, I had this little valley that I had to cross where the time decay gets really heavy. But eventually, as the price rises, it breaks out of it. And so, you can see that it's already on this upward trajectory. I really want NVIDIA in the next day to get above 625, because if it does, these two lines converge, and anything higher is just like huge profits. Now, I don't think NVIDIA is going to go up 20% by the end of the week, but it might go up 10%. And especially heading into what is likely to be a strong earnings week, and the stock's breaking out, and the volume pattern is nice. It looks like blue skies. It looks good. So this is a really important trading concept in options that I don't know why, but no gurus cover this. So this was something. I mean, I've spent a ton of time playing around with these combos in the simulator to find out discover this kind of stuff. This is a trade where you're putting down 1,500. If you put it on at the right time, see, if you buy it right now, you've got to pay a debit. So the amount you can lose on this trade right now is the debit and the margin impact. But when I put these on, I structure it so that they're a slight credit, which means that the most I can lose is my margin impact. And that's if I hold it till expiration. The implied volatility moving around can really mess with these, and they can get hit real hard. But the point is this: I mean, look at how much this can make. You know, if Nvidia goes up 10% more, I can make like 7 or 8 times the margin impact, and it's open-ended too. Like there's no limit to it. If Nvidia gaps up 30% tomorrow morning, which it could, then per combo I put on, per ratio back spread, it's $35,000 of profit a piece on 1,500 per combo that I put down. So the other thing to note about this is because it's a high price stock, the commission, and it has a very liquid options market too. The commission, the bid-ask spread is pretty liquid on these. The reason I like high price stocks that have super liquid options markets for doing these kind of trades is because you don't want to hold this until expiration if it's in this zone, because you're going to lose your whole margin. But if you let it run for like 3 or 4 days and it doesn't really start working, then most you're probably going to lose is about a third of this margin. And so that to me is like, that's a really great risk reward setup. Like you can see that. I mean, this trade for me is already up per combo like $2,200 plus whatever credit, right? So maybe even more than that. It might be like $2,500. And the most that I really had on the table was about $500 to maybe $500 or $600 that I had in play or at risk. The other thing that I'll note about it, and we're going to talk about this with Tesla, is because it's a back spread, if the price keeps falling, then I can reset the whole thing in lower strikes and just kind of start from where the market bottoms. So let's flip over to Tesla now and look at almost the same thing over there. And by the way, I'm going to call out that like if you try and put one of these together during an options expiration week, it looks like, or even like the week after options expiration, it's going to look way more expensive, and you can lose a lot more. And if the implied volatility drops, that can make you lose money faster. So I mean, I don't tend to do that. All right, now let's flip over to Tesla. If anybody has any comments too, by the way, feel free to drop them in there. I'll try and keep an eye on the comments. Okay, so Tesla. Let me see if I can even remember exactly what I put on today. I haven't been living with it for all that long, so I build these dynamically. I don't, I look at the market and figure out what I should be doing. So by the way, like look at how much how liquid the Tesla options market is. Almost 1 million contracts average are trading per day in Tesla. It's awesome. All right, so it's got all those prerequisites that I look for. It's got the high share price, the deeply liquid options market, and also that it's basing. That's the third requirement that I have. I don't like putting these on a stock that's already running because guess what? The implied volatility is already high, and it can drop on you. So if implied volatility is high, you'll see that if you play with it, it's a lot harder to build these. So Tesla's in this base. It's kind of at the bottom of this range. Now, I don't know that it has a whole lot of support other than maybe this 780 mark. But I don't really care, and you'll see why as we look at this. So Tesla is at 790 right now. So here's what I'm going to do. I'm going to go to let's sell a call that's I think this is the one I have. Yeah, I didn't start with this. I essentially started with one that was a little higher, and Tesla fell almost 10 points, and so I just rolled the whole thing down, which I'll show you about that later. And then I think what I had to do was buy 890 maybe. I think I ended up paying a slight credit for this. Yeah, that's a slight credit, but that's not the one that I had. How about this? Let's look at the 900. Where are we at? Yeah, I think this might be the one I have. But let's kind of build this a little bit more theoretically instead of looking at the exact one that I have. Oh, you know what I did? I know why the credit isn't big enough. Because I put these only 10 apart. So what happens when you do that is the margin impact is $1,000 per spread. I'm using a little bit further apart here. Okay, and what that does is now the margin impact is 1,500. We're getting a bigger credit though, so we can buy a little bit closer options out here. So let's buy. Let's do 2 of the 905, so you can see what it looks like when it's established as a credit. So I mean, it's like a slight credit. So where Tesla is right now, 791, and so that's kind of right here where this starts to really break higher. Now, this dotted line is where you can expect your P&L to go for this day, which is I forgot to announce the date at the beginning of this. February 16th, 2021. As you move this forward, you'll see that the line starts dropping. Anywhere close to this region, the line will tend to drop, and eventually it converges up here. And so for $1,500 of margin, we're looking at if Tesla runs up 20% in the next 2 weeks, which it does that kind of thing when it breaks out, we're going to be able to have a very big profit here. And the nice thing is, if Tesla goes down instead, don't really lose anything. And one of the tricks here is the bigger you make that credit, the bigger the cushion here on when it falls into the lower price range. So say Tesla falls down to the 50-day moving average that's coming up, and say it falls to 750 and then bounces higher, find support there. Then here's what I'll be able to do is I'll be able to put on pretty much this exact same thing, but where it breaks higher, where it would be at the 750 or 760 area instead of around 790 to 800. So the trick is to move this little spot right here down as the price falls. So if we push this to a 910. Then you'll see that now it's a credit, and so you can make it even bigger. Let me just illustrate this here. So what'll happen too is when the price falls, that can make the implied volatility get bigger, and when that happens, then it makes it so that you'll find that you have this credit. Because when the price fell, the implied volatility went up, and the options that this position, the composite position, actually became a little bit more valuable. It's a weird thing, but this is a position that becomes more valuable when the implied volatility rises. And also, it is a ratio back spread because we're buying 3 options and we're just selling 1. So it's just the one that we're selling is, it's got as much value as all the ones we're buying combined. And because we're doing it all on the same calendar, that's why this margin impact is really neat. It's tidy. Okay, so that's Tesla. That's how I'm playing Tesla. I put this on earlier today, and I'll be maintaining it, right? So Tesla falls a whole bunch, then I'll just roll down to lower strikes with essentially the same position. Okay, so we talked about that. There's just one more thing I wanted to cover tonight, and I'll try and keep it quick. I wanted to do a deep dive on this, but we're coming up on an hour. Yeah, it's been an hour now, and I'm trying to keep it to about an hour tonight. So CCJ, this is Cameco Corp. I talked about this yesterday, and so I want to show what I did with CCJ. All right. So the idea here is I have a long-term bullish outlook. And when I say long-term, for me, that's like 6 months or more. And you find these kind of opportunities in sectors that have been beaten down or sideways for a really long time. In this case, look, this is uranium. If we look at the uranium ETF, it's almost the same thing. Look at that. It's just been hammered for years. And so this kind of long-term opportunity, like look at solar, okay? This is the kind of thing that can happen, all right? Like solar was just beaten down for years. And then had a breakout, kind of like what's happening right now with CCJ. And so 1 year later, the sector is up tremendously. So I'm using this as kind of an analog for what we're likely to see with Cameco, if I'm right. And so it's a big if. And the idea here, let's call it a long-term options campaign. It's inspired by the guy, he's in Stock Market Wizards, the third Jack Schwager Market Wizards book. His name was Mark Cook. And he's still around, as far as I know. He's just maybe not as active as he used to be. I don't know if he's like a retired trader now or what. But that Mark Cook chapter in Market Wizards was really inspiring. I think it was like the coolest interview, I think, out of all of them. I mean, it really struck me at the time I read it. I thought, wow, I mean, this is like unbelievable. And so, but it inspired me that I realized something super important about that interview that I don't know that Jack Schwager called out, is that this guy is a farmer. He's a farmer. He like plants seeds. It takes a really long time for the seed to grow, but it grows up all the way into like a great big plant, and then it gets harvested, and it's awesome. You get to enjoy the food, and if it's, a little tree or whatever, like apple tree, then you get apples for, for years. And so Mark Cook's story inspired me with this strategy. When I was really thinking about what it is that he might be doing, because I don't have a whole lot of insight into what he's doing. But when I think about the possibilities and that he was a farmer, a long-term options campaign can be like that, where, it can take a year for something to grow from really small to really big. So looking at Cameco, what's really small in the options world, and also with a long time out. The furthest out we can go is this one right here, or it's not the furthest out in calendar, it's the furthest out on strikes. I'm looking about 1 year out. And what I've done is I started accumulating the 30 strike, which is out of the money. And so one thing that is super important with options is that depending on where the underlying is relative to the strike price of the option, and also in calendar where it is relative, the option will have a time decay at a different rate. And so, this 15 strike that's in the money is going to time decay a lot slower than this 30 that's out of the money. However, the 30 with a year to go is going to time decay a lot slower than the 30 with 6 months to go. So that's why I'm going so far out, is because I want to start accumulating out of the money options. And if the price goes down or the move fizzles out or whatever, there'll still be some time value left. I can abandon the campaign. Maybe I lost half my money or 2/3 or whatever, but I was just planting seeds in the dirt anyway. So it was no big loss. And the idea here is, I talk about these swoosh positions all the time. The idea here is I'm essentially doing some long range planning so that in about 3 to 6 months time, I'll have an option that's at the money that I can convert into a swoosh position. Only check this out. Here's the awesome part, is when this 30 strike is at the money, and let's say it takes, a couple months to do it. Say it does it by April 15th. According to this simulator, that is going to give us an estimate the option, the 30 call, which, it's way out of the money. It's as far out of the money as we can even go. It'll be worth, let's see here. We'll have paid, let's say, $1.50, and it'll be worth $1.50 plus $800. And so we'll have already multiplied our money maybe 5 times over. And so at that point, what I can do is I can roll that contract in so that it's got between 3 and 6 months of duration left on it. And any proceeds I get from that sale, once the option's at the money, then I'll convert it into a swoosh position. And what I'll have done is I've been able to establish that swoosh position with about 20% of the capital that's required if you just put the swoosh position on now with 3 to 6 months of time to go. So because this is a sector that's emerging into what looks like maybe a long-term uptrend with some positive fundamentals, then we could do this kind of long-range planning with some reliability. And so with a very small amount of capital, the idea is that, and where I want to be buying these, by the way, is on down days. So, once I've got a little bit established, then typically every down day, I want to be in here just nibbling. The reason is because when the option, when the price moves down, these out of the money options get hammered. They go down hard. So if you look at the chart of it, you'll see that it's, if you buy it on a down day, you can get like really good deals. Whereas if you buy it on up days, you're going to be overpaying. And so because there's so much time left before we get to 30, there's going to be down days along the way. So, I'm not in a rush. I gave myself plenty of time. I wish I had higher strikes, though. I might have used a little bit higher strikes. But that's okay. I mean, there will be higher strikes later. And you can do this multiple times. You don't even have to just do this once. So anyway, let's go back to what's the second phase of the campaign. So we talked about phase 1, where we're sort of like planting these seeds, doing some slow accumulation of what are just about leaps. This isn't quite a leap. So phase 2 is we we convert that once it's at the money, and so Cameco rallies to $30 a share. We roll it in so that it's got about 6 months of duration on it. Now let's look at one that is at the money right now with about 3 to 6 months to go. So we're going to look at the 18 here. Okay. Now never mind that this 18 is a $2.30 option. I've already shown you what you can expect the 30 to be. All right, so 18, and then to convert it to a swoosh, what you'll need to do is with about 3 weeks of duration, we're looking to buy a put that is about 10% lower. So in this case, it would be like a 16 put, I think. And yeah, let's see what that looks like. Okay, we're looking at too much time here. There we go. So now it looks like the Nike swoosh, right? That's the idea. And so what this does is, now this is a hedge. It's a protected position. And if the price falls, then we can roll lower on strikes for our call. And the time decay on this position doesn't come from the call anymore, really, because the call, we keep it at the money or in the money. However, the put is a little bit out of the money, and it's short duration. So we keep that put rolling at the 16 strike or thereabouts. And eventually, the idea is that it will be so cheap that it's no longer really a meaningful part of the position. Like earlier tonight I showed with the riot. So so that's phase 2. And then phase 3 is ideally, once the delta gets to 1 on these, if the price rises high enough or the delta gets really close to 1, we can essentially exercise those options. And we might have to pay a small debit to do it. That's okay. I mean, maintaining this position will cost a little money. Or we could liquidate part of the position to finance it. I mean, there are plenty of other ways to do it. Another way you could do it is like roll up and out on strikes a little bit and just wait until you've made a little more money if it continues higher, and then exercise it. So I mean, there are plenty of ways to finance it. And then once you've got the shares, then there are 2 different things you can do with it. And I mean, you could do them both, but one thing is you can move it from a margin account to a cash account, and then those shares sort of become a part of your wealth, right? Like you've harvested this plant. The other thing you can do with it is you can do what's called Warren Buffett uses this strategy. I watched some neat YouTubes about it. It's called the wheel, and so you can sell calls against your shares, and if they get called away, then what you could do is you can start writing puts at prices that you'd like to buy it back, and you can keep collecting premium until you get the stock put to you, and then you're back in your position. And so, I view that as sort of, that's the apple tree going in and out of bloom, and through the seasons giving you apples, right? So, and I've shown how we can build this from a very, very small amount of capital and grow those tiny little seeds into what could be very substantial wealth. I mean, by the time that delta is 1, I mean, the stock will, or close to 1, the stock will multiply many times. So, and the options, like many, many more times even than that. So anyway, that's really what I wanted to show. As far as AG goes, First Majestic, I'm doing a similar thing with First Majestic as I am with CCJ. It's really early on in what may be a bull market soon for the gold miners. There's certainly some positive fundamental factors there. So, all right, well, I'm going to go ahead and end it there. Thanks for watching. And if you liked it, please give it a thumbs up. Help me get the word out on the channel. So you can follow me on Twitter. It's at Jon Tait, Jontait. And thanks so much. All right, good night.